Welcome to Smart Advisor channel. It's been so long, so we are back now with a video. Thanks a lot, guys. Thank you so much for your likes and comments and shares. I'm getting a overwhelming response from you guys. Thank you so much, guys. We'll rock. Yeah, guys, today we'll have a look at technical indicators. So far we are considering only about fundamentals of a stock. Even in my videos I used to refer to technical indicators in some of my videos while referring the few stocks to you. So we'll have a look at technical indicators. So guys, before purchasing this company of a stock, we'll consider the two things. One is the fundamental analysis and the second one is the technical analysis. In the technical analysis we have some different kinds of technical indicators. So among them, moving averages is the one of the most important technical indicator. Even the intraday traders and short-term traders and for long-term traders and investors, they will consider the moving averages to decide whether the stock is going, we are going to purchase the stock or not based upon these moving averages. So we'll have a look at the definition of the moving averages today. So what is the definition of moving averages? The definition of moving averages is simple average of closing price of a stock over a defined number of time periods. Read again. Simple average of closing price of a stock over a defined number of time periods. There are two kinds of moving averages, guys. One is simple moving averages and the second thing is exponential moving averages. We'll have a look at in detail what is meant by simple moving averages and how do we calculate and what are the different types of simple moving averages. And second thing is exponential moving averages definition and how do we calculate it and what are the types of exponential moving averages. So let's coming to the simple moving average first. The formula to calculate the simple moving average is day 1, day 2, day 3 divided by number of days. This is the formula which I have written on the screen, right? So what is meant by day 1? Day 1 is the closing price of a stock at day 1, and then day 2 is the closing price of a stock at day 2, and then closing price of the stock at day 3 divided by the number of days. So we'll explain with an example. Let's consider a stock A. Stock A closing prices for the last 3 days is the day 1 closing price is 20 rupees and the day 2 closing price is 30 rupees and day 3 closing price is 25 rupees. So now we'll calculate the moving average of a stock A for the 3 days. Okay, how do we calculate? So we'll consider the day 1 closing price and then day 2 closing price and day 3 closing price divided by the number of days. So the day 1 closing price is 20 rupees and day 2 closing price is 30 rupees and day 3 closing price is 25 rupees. The total sum of day 1 and day 2 till day 1 to day 3 is 75 rupees and the number of days is 3. So the total simple moving average of 3 days of a stock A is 25 rupees. So usually we hear in the news and even in the financial advisors tell us the stock price closed at below the 10-day moving average, 20-day moving average, above the 20-day moving average, below the 50-day moving average. So all those kind of days of moving averages calculated based on this formula only. The formula, I'm repeating it again, guys. The formula to calculate the simple moving average is the closing price of the certain period of time divided by the number of days. So are we clear now? So let's take an example. Suppose we are going to calculate the 10 days of a moving average of a stock. So what we will do, we'll take the closing price of day 1, day 2, day 3, day 4 till the day 10 and divided by the number of days, 10. So after once you are done with that calculation, then you will get the simple moving average of a stock for the last 10 days and similarly to the 20 days and 30 days and so on. So what are the types of simple moving averages? So usually in the in the charts we are able to see 10 days the moving average will be calculated on predefined basis, 10 days, 20 days and 30 days and 50 days, 100 days and 200 days. So mostly 10 days and 20 days simple moving averages are considered by the till 50 days moving averages are considered by the short-term traders, and 100 days and 200 days, even 300 days simple moving averages are will have it. I mean those days will look by the long-term investors. Now we'll have a look at exponential moving averages. Before going to the exponential moving averages, what is the use of the exponential moving averages even though we have the simple moving averages? The drawback is, let's take an example of 50-day moving averages. After 25 days, the company announced quarter results or some news. So suddenly after that, the stock price of the company will increases. Let's take on an average of last 25 days of the stock price is on an average 5 rupees. After the last 25 days stock, after the 25 days is let's take an example of 10 rupees. So when you consider both an average, you will get the 7.5. So it doesn't give it, maybe the stock price is 10 and the moving average it is showing for the last 50 days is 7.5 rupees. It doesn't make any sense, right? So there is a huge difference between the current market price of the stock and the 50-day moving average of a stock. So in that case, to avoid those kind of differences, so we have, the analysts came up with another approach called exponential moving averages. And what is the difference between the simple moving average and exponential moving average is, in the simple moving average, we'll take the on an average, we'll take the consider the bulk, we'll consider in the on an average of the closing price of the stock divided by the number of days. Here what we will do is, in the exponential moving averages, we'll give a over high weight to the recent prices. I am telling you again, we are in the exponential moving averages, we will give more weight to the recent prices. How we will give the more weight to the recent prices? Let's take in the previous example only. Let's take stock A. Closing prices of day 1 is 20 rupees and day 2 is 30 rupees and day 3 is 25 rupees, right? So how do we calculate the exponential moving average of a 3-day stock for the same stock? So 20 rupees we are multiplying it with 1, 30 we are multiplying it with 2, and day 3 we are multiplying 25 with a 3. So why? The 25 is the most recent closing price of a stock, so that's why we are giving more weight to the stock. And 30 is the yesterday's. Let's take an example. 25, day 3 is today and day 2 is yesterday. So yesterday's closing price is 30. So that is why we are multiplying it with a 2. So we are giving less weight to the 30. So yesterday's correct market price. And the day before market price is, closing price is 20 rupees. So that's why we are multiplying it 1. So we are giving less weight when comparing to the day 1, day 3 to day 1. Are we clear, guys? I'm telling you again, we will give the more weight. We will give the more weight to the recent price of a stock in the exponential moving averages. So now how will we calculate the exponential moving average of these three? So 20 into 1, 30 into 2 plus 25 into 3. So 20 into 1, 120, 30 into 2, 60, 25 into 3, 75. 20 plus 60, 80, 80 plus 75, 155. And divided by number of days we are calculating plus sum of the days, maximum overweight day. This is 3. So 155 plus 3 plus 3, we are getting 25.833. So see, guys, in the simple moving average we'll get the last 3 days moving average is 25, and in exponential we'll get 25.833. so you see the difference, right? So I'm telling again, in simple moving average we'll calculate only based on the last average of the closing price of a stock divided by the number of days without doing any extra calculations. In exponential moving average we will give more weight to the stock prices for the recent prices. So that is why we have to multiply with the number of days and then we have to add the same thing. So then we'll get the exponential moving average of a stock. And guys, yeah, I came up with this topic because of so many people are asked me about them what is meant by moving averages in the mails. So that's why I came up with this technical indicators topic. So in future, to come up with the more topics to enlighten our knowledge more for you and me as well, so kindly shoot me with the questions and kindly provide me the feedback so that I can improve my way of making the videos. And then in the topic wise, so kindly shoot me with the new questions, so we'll come up with the new topics. All the best, guys. Happy trading. Chill.